Hi everyone, welcome to the webinar. We're just going to wait a few minutes so the room can fill up before we start. First, let me thank you all for joining us today, and the webinar will last around half an hour. We will talk a little about various subject matters, and we will then go through some questions at the end. We'll give it another minute and then we'll start. Right, looks like we're ready to go. So firstly, hello everyone. My name is George Antonio, Managing Partner of the Accountancy Division here at Fusion, and I'm joined by our Head of Accountancy in London, Pratul Shah. Welcome to our final webinar of the summer series, 5 things your accountant should be doing but probably isn't. Some may argue we have left the best to last, but Mitch the Taxman may have something to say about that. All right. So Fusion is a professional services business offering a 360-degree service for our clients. Some of the services we offer are accountancy, independent financial advice, financial recruitment, corporate legal services, and high-end tax advice, which covers tax efficiencies and wealth protection. The whole idea behind that is to have a client in the middle and all their advisors around the table and sitting in conjunction with each other and giving the best advice as possible. So moving on to the content of the webinar. Over the past 24 years, I have taken the approach of listening to clients and ensuring that good communication is at the top of the agenda. I couldn't tell you how many times the first thing prospective clients tell me is that they cannot get hold of their accountant or their accountant is not being proactive. So here at Fusion, we have allocated qualified accountants to manage each client's accounting needs and be an accounts manager for them of sorts. We try to make them available at all times for our clients, and on occasions when they are not reachable, we have the heads of each office that can be contacted. And of course, I'm always here to have a chat whenever is needed. The point being is that in the traditional sense, to get hold of partners has always proven to be very, very difficult. So we train our team, our staff to partner level in essence. So our clients are not thinking that they're not chatting to a qualified accountant or someone that has the entrepreneurial experience that comes with being a partner of an accountancy firm. You also have direct contact to our payroll team for anything payroll related, and this way we ensure that this important aspect of anyone's business is dealt with in a timely fashion. So we've designed it like that in essence, that you don't have to go through your account manager to discuss the monthly payroll needs that you have. We've got our payroll manager, our payroll team, where you just liaise with them on a monthly basis and just go through anything payroll related. Furthermore, we have invested heavily in building a client services team that is dedicated to each client to ensure we have a smooth relationship with each client. Therefore, on occasions where you may not be able to reach the accounting team, you can speak to your client services representative and they will ensure your message gets across to us. This team is also responsible for sending out various communications throughout the year to ensure you are kept in the loop with any developments at Fusion. So I will hand you over now to Prato, who will cover some of the other points that are raised by clients.
Right. Thank you, George. So just a bit of introduction about myself. But before that, thank you for taking the time out of your busy day, especially during lunch, to listen to us. I'm sure it will be beneficial in the long term. So regular financial health checks on your company. So what do we mean by that? Usually when accounts are prepared, they're usually prepared in arrears. We're looking at maybe 4 or 5 months, 6 months after the accounting period end. But what we do here is usually for our medium to larger clients, we prepare monthly as well as quarterly management accounts. So we're always looking forward to how the business is doing, as well as giving updated information as and then. So we can look at any potential opportunities arising as they are, rather than looking at it in arrears. And I'm sure that this would help if there's anything in going on in the future, like if you want to buy something or if there's cash in the bank and you want to invest it. And that's where one of our Fusion Financial, one of our divisions, would come and help. I'll move on to...
Just before you move on to the next point, it's a really good point that Prattle made there, is that in our London office, we've got all the service lines here under one roof. So as mentioned, a good example is where sometimes we see clients have got a substantial amount of cash sitting in the bank, and usually it's just sitting in the bank's current account, not doing anything. They're not planning to use it at any stage. So we would then get them straight across to our corporate team to have a look at investing that money somehow for them. And it can stay as liquid as possible, earn a little bit of interest, or if you're prepared to invest it for a slightly longer term, we can get better rates for it. So just an example of we're constantly in communication with each team, discussing the client's financial assessments and needs going forward.
Yeah, thanks, George. All right, so moving on. So salary versus dividends, an update on the old thinking. So it used to be the case previously that the most tax efficient way of extracting profits from a company for directors, shareholders, would be by taking a minimum salary and the rest of the profits through dividends. We believe that that is no longer the case. We have to look at it on case-by-case basis. But as you are all aware, the corporation tax rates of the companies have increased. Used to be 19%. Now it's 25% for companies with profits of more than £250,000. So is it always the best option for directors and shareholders to take minimum salary and then the rest in dividends? Because the dividend allowance used to be £5,000 and it's reduced significantly to only £500 for this tax year, 24-25. And with the budget coming up on the 30th of October, we don't know whether that allowance is going to stay or there will be no allowance at all. So we would suggest, depending, as I said, on a case-by-case basis, we would look at the company and the profits they're making, as well as what the salaries are being taken out. And there may be an option where the director shareholders take out a larger salary and a smaller dividend. When they take out a larger salary, or in maybe the case where they take out bonuses, they could get relief at 25% corporation tax, as well as getting relief on employers' NIC on the bonus. And we have a sophisticated, I think, software in place where we could do various calculations to ensure that there is a most tax efficient option of extracting profits from the company on a case-by-case basis.
Yeah, just touching on that, one of our senior advisors here in our wonderful tax team has created an algorithm where we put in all the variables, salary, what kind of dividends, and it works out the optimum split between salary and dividend for each company's or each client's necessities. So we've got that relatively quick to hand. We can calculate that out for various and put various details in there, and we will always give you the best possible solution. And you'll be surprised that the old way of, I don't know, £10,000 salary and £90,000 dividends in a year is not always the most beneficial for each company. So feel free to give us a shout so we can discuss that at any time.
Thank you. New associated company rules. It used to be the case previously where we had the 51% rule of association, but this was when all the companies were taxed at 19%. The new associated company rules came in from 1st of April 2023, and it usually is if you are considering or if you have companies in a group. So where companies are in a group, the large company profits at the moment are 1.5 million for an individual company. However, if you have companies in a group, let's say you have 5 companies in a group, including the holding company, you need to divide that 1.5 million by 5. So that means that your profits have reduced significantly to 300,000. And it could be the case where you could become a large company for tax purposes. If this is the case, then you need to be aware that you have to pay tax on quarterly installments. And the quarterly installment, the first installment starts at 4.5 months after the accounting period end. So if your accounting period end is 31st of December, the first installment needs to be paid by middle of April at the latest. So we need to be careful how you have, especially companies in a group and where profits are rising significantly. We had a case recently where HMRC charged interest of £17,000 on a company. So it was 2 companies in a group. One of the companies was dormant. So where it is dormant, you don't use that for associated company rules. But they were not aware that their profits had increased significantly to 1.5 million. Again, it's an awareness. Just be careful you're not caught out, because it is very difficult to appeal to HMRC about this interest because they're taking a tough stance on this.
Yeah, so this is a sore subject. Many years ago in another firm where I was at, I did get caught out by this, where the profits did go over the 1.5 million. We didn't keep an eye on it, and the client should have gone onto the quarterly installments. They didn't, and they got stung with some interest. And it's so surprising, or it's not so surprising, that we take on prospective clients and the first thing that we spot is that their profits are of the large company size. They should be on quarterly installments, and the clients just don't have a clue that they had to be paying in installments. So even at the very beginning, when we're talking to prospective clients, we look at all of these aspects of their business just to ensure that they're not falling foul of any of these, because no one wants to be paying HMRC interest for, it stinks for nothing.
Thank you, George. Considering P11D implications, I know the P11D that for the tax year you would have, it's just gone, it's completed, filed. But what we are saying is you need to be careful where, like company cars, are they making a comeback? So it used to be a case back in the day where expensive cars were not worth as such putting into a company because of the large engine sizes and CO2 emissions. But now we've got a selection of electric cars available where the benefit in kind at the moment is 2% for this tax year, and then it's going to increase to 3% from the next tax year on the value of the car. And it could be the case with electric cars that when you lease an electric car, you get tax benefit. You can put it through the company. You get corporation tax relief at 25% for a large company. Plus, where you are VAT registered, you can also claim 50% VAT on that. So it could be a case where company cars, we could see more of a comeback happening on this. The other areas we need to be careful, especially for directors and shareholders, is where you're providing benefits such as gym membership, life, health insurance, for example. And there could be some auditors out there. Just be careful that you're aware that a P11D could be in place where a company is providing a benefit not just to the employees but the directors as well. So another option could be where you could consider a PSA. A PSA is a PAYE settlement agreement which you have to have with HMRC before the start of the next tax year. So you have to have it in place. It is a very good option available whereby you give benefits to employees of the company without the benefits being taxed on the employee itself. It could be Christmas party, summer barbecue events, as long as the benefit is, if the benefit goes over £150 per head, then a PSA would be a better option, because then the company pays for the tax on it and gets tax relief, and the employees don't get taxed on it. And this is something we can offer here on a case-by-case basis to look at.
Yeah, so look, if it's talking about company cars, I can talk to you about cars all day long, but we only have half an hour to talk. But yes, it's true. Company cars before electric cars came out and more CO2 efficient cars came out, they were a dying breed. We once used to stop advising people to go for company cars because it just became far too expensive to be paying that much tax, that much NI on a expensive high-end car. But having said all of that, electric cars have taken on leaps and bounds. We've got some really lovely cars out there at the moment. So you'll be surprised, even though they are expensive, and I don't know, get a really flash car for 80 to 100,000 pounds. The benefit in kind at this present moment at 2% could be really, really worthwhile to look into. We do appreciate that the benefits are rising, so they're going to 3% next year, and they will continue to rise as we see fit. But you never know. They rose before, and then they dropped back down. So we'll see what the government wants to do, what kind of push they want to do with the electric cars and the electric infrastructure. But please do bear in mind, it's not just the simple things like a company car that triggers the P11D benefits. You might be paying some sort of medical insurance and not realize that you have to be doing this reporting and paying national insurance from the company's perspective on these amounts. Obviously, the employee will have to pay tax on those amounts. So please do bear in mind that these things will trigger reporting and tax necessities. I'd like to take a minute just to remind you that we do have the questions and answers, so please feel free to ask anything you need, and we'll go through that in a little while. But generally, as an overview of the webinar, I think it's most important that we reiterate that communication with your professional advisors is the most important. Now, you might argue that you do try and reach out and you don't get answered and things like that. But we here at Fusion pride ourselves on responding pretty much straight away. And as I said before, if you can't get hold of your actual dedicated advisor, we've got the client services team here where we're in the same office. You give them a nudge and they will come over and talk to us straight away, or find someone that can get an answer to you. We're a broader team. We're spanned across 3 offices in the UK at present. So there's always someone available to be able to give you some advice or just talk to you for whatever needs that you have. So at this juncture, let's just have a look if there's any questions here. First question I see is someone is asking, there's no sound, but I hope the sound did come. That must have been early on. So Someone's asking, as accountants, do you help landlords who is new to the market? So in that sense, we can help in giving the accounting advice of perhaps how to set up, how to account. Should you be a landlord and have this property investment as an individual? Should you be through a corporate entity? We can obviously have a chat about these things in conjunction with our tax team. So please feel free to get in contact with us. Somebody else is asking here, what is the most tax efficient way for an owner selling his company to take cash out from the business account? So once again, there's more than one answer to this, and it depends on how much is in the balance sheet, whether practitioners need to be involved to find a solution for you. Again, Marcel, please contact us and we can run through all of that to find out what can be the best way for you if you need cessation accounts doing, and then discuss which element is the best way or which strategy is the best way to take that money out, whether it's a dividend route or whether we can go through a capital route for you. Do you want to take the next one?
Yeah, so the next question we have is, does tax credit finance mortgage costs when calculating the tax gets deducted at the end? That's a good question. I'm assuming the finance mortgage cost is not in a limited company, but as a individual, in which case, correct me if I'm wrong here, would be you get tax relief. Used to be the case where you used to get 100%, etc. But now it's just down to the basic rate element of 20%, where you get your mortgage interest relief, and the rest you get taxed at on your income tax bands. If it's a limited company, you do still get the full mortgage interest relief against the company tax rate. Any other questions?
Is it the same question?
Yeah, that was the same question. Most tax efficient.
Okay.
But
we have got one question here that is asking, what kind of electric cars are available, as I don't want a boring old Skoda? So first and foremost, a little bit offensive to Skoda, because I do believe they have been building very nice cars of late. But yes, depending on what you need, if you need some fleet cars or you need something with more stature, almost every mainstream manufacturer now has an offering. You don't have to go just for a Tesla anymore, which we do know are lovely cars, but they do have build quality issues. So if you want more of a traditional BMW, Mercedes as an executive car, there's some really, really nice cars out there. Again, we do know they are expensive, but you might want to look at the lease route, where, as Pratul has already said, you'll get 100% of that cost as a rental expense off your profits. You'll get 50% of the VAT back, and then the benefit in kind at this present moment is pretty good at 2%. You won't be paying that much tax as an employee. There's one right at the bottom there.
So, another question we've had is, we've had quotes recently from accountants. Some are a monthly fee, others are a one-off fee. What's the standard practice now? Again, it depends on what accountancy practices have. The traditional accountancy practices still do the one-off fee, where they prepare the statutory accounts, corporation tax, and then charge you a fee at the end. Now, the con or the negative side of it would be, depending on cash flow, you might get a large bill at the end of the work done. And if they hadn't quoted, if it's like a monthly, it's a hourly rate or a day rate, then the fees could rise significantly. So unless they have quoted and said that unless there's anything else, then maybe a one-off fee right at the end could be for some of the traditional accountancy firms. there have been instances recently where accountants charge a monthly fee through a subscription model. Now, that's what we do at Fusion here. We always quote a fixed fee in advance of work being carried out. So it is transparent both from the client's perspective and our perspective in what work we do. And we just don't provide compliance services. We also provide advisory services. So we are your advisors, not just compliance, like ticking the box. So that would be where our quote would include not just doing your accounts, filing them, corporation tax, filing them. You can pick up the phone whenever you want or have a Teams call, etc. And we're not going to be like lawyers per se, where they just charge every time you ring them. They just put the timer and say, well, this is what it's going to be. It's all in the fee, because at the end of the day, as I said, we're advisors. We're here to help you and help your business to grow and succeed. So what we do here is a subscription model, monthly fee in advance. We say that this is what it's going to be. You sign a letter of engagement. And also from your perspective, you know how much cash is coming out of your business on a monthly basis, and you plan accordingly.
So sorry to any solicitors out there if we have offended you. But yeah, it's a really, really good question, actually. And we are seeing more and more our competitors and accountancy firms moving over to this subscription model. It's something that we do here at Fusion. We take all our clients on the subscription basis, so everyone has an understanding at the beginning what the fee is, what they're going to be paying, helps their cash flow. And then we've got a few benefits that come with that. You know, we've got, as Pratul said, there's general advice included in that. So we're not going to charge you any more for any sort of standard advice that we give throughout the year. We also have fee protection insurance included in the fee. So in case you've got any inspections from HMRC, that's all covered for you. So yeah, that's a model that we've chosen to follow, and more accounting firms are doing it anyway. So the old ways are being phased out.
Thanks, George. Another question we had is, how much do you charge for self-assessment?
So I would say get in touch there with us, and we can put you in touch with our tax team, and we can discuss your needs and give you a quote. Everyone's needs are different, so we can't give quotes out online here.
Okay.
Right. So it looks like we've come to the end of the webinar, and if there's any more questions, please feel free to come to us offline, and we can discuss anything we need.
Yeah, no, thank you all for listening to us, and hopefully it has been more of an educational awareness rather than a sales pitch from us, because both of us are, honestly, we are more accountants, not salespeople. But as I said, yeah, please do get in touch. As I said, there's a free consultation. Any initial consultation we are offering more face-to-face rather than, and as well on Teams. So we'd like to see people coming into the office, seeing into our offices and meeting face-to-face. So please do get in touch with either George or myself, and we can take it from there.
Right, so we have now come to the end of our summer series of webinars, and the recordings of all of the previous webinars are now on our website. So please feel free to take a look, as there are some really interesting points being raised. Thank you, everyone. Have a good rest of the day and take care.
Thank you.